First up, commodities. They took a beating Wednesday. Copper prices collapsed to 5.5-year lows, and we're going to tell you what this could mean for the global economy coming right up. Then Dennis Gartman will be joining me live on the show. The man behind the Gartman letter is sitting down with me to talk about capital markets. What an appropriate day to talk about that. And while commodities were getting sacked Wednesday, the collapse did lead to a global bond rally. Edward Harrison is going to be telling us all about this in today's Big Deal. It all starts right now. Wednesday, Bloomberg's commodity index fell to its lowest level in 12 years. Now, this comes after a rapid decline in the price of copper in after-hours trading on Tuesday took place. Copper hit its lowest level since July 2009, tumbling 5%. Now, the crash in copper prices is the latest in a global commodity sell-off that is being driven by a decline in the price of oil. Low energy costs make it cheaper for mining companies to increase production, while disappointing economic data from China is also adding to concerns about the demand for the commodity. The frightening thing, though, the really frightening thing, is that no one really quite understands why copper is declining so much and so rapidly. Here are two theories, however. One, cheap oil is creating a greater supply, and the drop in the price of copper is a result of speculation that cheaper energy costs will be encouraging mining companies to increase production. The second theory is that the demand for copper is going down simply because the global economy is slowing. The World Bank released a lower growth forecast for the global economy on Tuesday, which could also be pressuring the commodity as well. So could copper be the canary in the macroeconomic coal mine? Very possibly. The problem is we just can't identify which danger the copper canary is trying to warn us about. Scary stuff, but do stay tuned to find out. We're joined now by the always wonderful Mr. Dennis Gartman, publisher of the Gartman letter and capital markets expert. Welcome back, Dennis. I always love having you on the show. And I'd like to start off our conversation by asking you about commodities. Now, we sent you a chart of Dr. Copper earlier today that Joe Weisenthal of Bloomberg tweeted. Now, here it is. We're going to throw it up on the screen. Copper, another commodity, that's getting eviscerated. Boom. Or should I better say bust? What do you think, Dennis?
Yeah. Well, a lot of people look at copper and give it probably a little too much credibility as far as its ability to forecast economic circumstances. There's a lot of people on the street call copper Dr. Copper, as if copper has a PhD in economics. I will say that copper probably has a very nice bachelor's degree from a middle-ranking university. However, if you take copper, aluminum, tin, zinc, throw them all together, in aggregate, they may have a PhD in economics, because it wasn't just copper that was weak. It was all the base metals. They are all very weak. I suspect that they are telling you that, yes, economic circumstances are probably going to be weaker than almost anybody had thought. Yes, mining has been picking up because of the decline in oil prices. You talked about that. And three, let's not doubt for a moment that there's probably a large hedge fund out there somewhere that is liquidating under duress, getting rid of positions. I wouldn't be surprised if we find something untoward and very ugly having occurred. Too many people were far too long of commodities predicated upon an expectation of inflation, and I think a lot of people, I think somebody out there probably has had to throw their hands up and liquidate positions under duress.
Interesting. Now, what happened to the commodities bull market? I mean, is the slide in commodities about a strong dollar, or are we seeing something much, much, much more dangerous?
Well, I would say that probably 60% of it is the fact that the dollar is as strong as it is, putting downward pressure upon commodity prices. I would say that probably 20% is predicated upon expectations of a weaker global economy, and probably the last 10% is just specs getting taken out of long positions, because the specs, the speculators, are very rarely on the short side of any commodity. They're almost always a buyer. I've never understood that. I've only been at this now for 40 years, so I'm relatively new at it. but I still am amused at how everybody always wants to be on the long side of commodities, and I think people are just throwing their hands up, understanding that inflation is not the problem, that deflationary pressures are indeed the problem, and that's driving things down.
Now, obviously, speaking of booms and busts, we have to talk about oil. Oil is in something called contango, meaning the front near-term contract prices, they're higher than futures that settle later. Now, this incentivizes traders to store physical product to lock in prices. So can you tell me a little bit about the dynamics of crude storage and rising tanker rates? You know about this.
Yes, this has happened before, and it's happening right now. You now take a look at Brent, for example. The difference between front-month Brent and one-year forward Brent is almost 25%, i.e., if you took delivery of Brent futures, held the crude oil, and sold the deferred futures, you would make about 25 to 26% on your money. People are now taking advantage of that contango, and contangos occur when you have a large, an excess supply and far in excess of demand. Crude or whatever commodity we're talking about bids for storage. It goes into storage, and you have this circumstance called contango. With that as large as it is, people are actually going out buying old or leasing old tankers, putting the crude oil into it, selling the deferred futures, and locking in what looks to be like a relatively riskless transaction, so long as you have the tanker in place, so long as you have the borrowing capabilities to buy the amount of crude oil predicated or needed to fill that tanker, and you have the borrowing capabilities to fund margin calls along the way. But this is happening. There's probably now about 25 large tankers out there in the water that are being used solely for the purpose of basically sopping up the excess supply of crude oil that exists. And this is going to continue for a while because clearly the Saudis are continuing to supply crude. Certainly we are continuing to supply crude. The Canadians are not about to shut off their crude production, nor are the Venezuelans. There's a lot of excess crude out there, and it's got to go someplace. It's either filling up tanks around the world above ground, or now it's putting pressure, it's filling up tankers on the water, which is reducing the supply of tankers needed to take crude oil around the world, so day rates for tankers themselves are going up, and those stocks are getting quite strong.
Such an interesting side effect. Now, Dennis, you're long tanker shares and gold, so why is that?
Yeah. Well, I'm long tanker shares for what we just explained.
Yep, that makes sense,
The supply of tankers is being reduced simply because they're going into the contango trade. So I'm long tankers. They got a little excited, I have to admit. Even I was surprised because some of them went up in the course of less than 3 or 4 days. Some of them went up 100%. Some of them went up 75 or 80%. The last 2 days they've corrected decently, which is a good thing. So I'm back in buying tankers again. I've owned gold for several years, but not gold in dollar terms. I have no interest in gold in dollar terms. I have great interest in gold in euro terms because I think the euro is going to be an ever weaker currency and an ever cheaper funding capability. I own gold in yen terms, which has been a wonderful trade for several years. I wish that I had had the temerity to buy gold in ruble terms because that would have been the greatest trade of all, given the demise of the ruble. So I'm long of gold, but in currency terms that are weak currencies.
And what about the respective derivatives markets there?
Well, you can either put the trade on, you can buy gold futures and sell the interbank market rate in yen or euros, or you can go ahead and buy the ETFs that are listed on the New York Stock Exchange, GYEN or GEUR, gold yen, gold euro. The gold bugs don't like me because they always want to be long of gold in dollar terms because they're always expecting the dollar to go into some sort of chaotic demise. And so even though I've joined them on the bullish side of being bullish of gold, they have a hard time understanding why I want to be long of gold in non-U.S. dollar terms. But there are derivatives out there that will afford you that trade.
Interesting. Now, Dennis, what's your view on the U.S. market? Are you bearish or bullish on shares?
I was bullish of shares, honestly, for quite some period of time until yesterday. We started to, I'm very simple. One of my favorite hedge fund managers, an old friend of mine, once said, sometimes it helps to think about trends as a 4-year-old would think about them. And if you hold a chart in front of a 4-year-old that's moving from the lower left to the upper right and say, what is this doing? They'll say, that looks like it's going up. sometimes you need to take things simplistically that way. Hence, thus far, the stock market until the past week or two had been moving from the lower left to the upper right. It was constantly the proper thing to be a buyer, to look for weakness. But suddenly we've stopped doing that. Suddenly we're starting to break trend lines that have been extant for a long period of time. Suddenly we've stopped making new highs. Suddenly the stocks that really were the leaders, such as Apple, have refused to make new highs. So suddenly we're starting to do we're having detrimental circumstances prevailing as far as the psychology, as far as the technical circumstance of the market is concerned. Yesterday was a particularly acute day when you opened up as sharply higher as you did and then ended up the day lower, called a reversal day.
Yeah.
Today, again, we followed through on the downside. Yes, some are making a great good deal about the fact that we bounced hard from the lows, but I think damage has been done to the psychology of the market. I think damage has been done to the charts, and I think that the economy of the world is slowing down just a little bit, which is the fundamental reason why you're probably going to get some weakness in stocks. So I had been bullish until yesterday. I've actually gone quietly to the bearish side of the market, and the operative word here is quietly. Not extraordinarily yet, but the fact that we traded as badly as we have causes me some concern.
Dennis, we only have 30 seconds left, but I want to ask you, and this isn't a commodities question, but I'm curious, why have interest rates dipped so much when the U.S. economy has been doing relatively well? Do you have a view here?
Sure. First of all, the trend has been down for 30 years, and that trend hasn't stopped. Two, money is moving to the United States because it is still the best place for money, for frightened capital to move to, which is constantly going to put downward pressure upon rates. And three, we are in a deflationary circumstance around the world, so that rates can still go lower. And everyone you talk to, every smart guy, every smart woman thinks that rates are going to go higher. The contrarian says rates are going to go lower. Rates are probably still going to go lower.
Well, we'll have to wait and see. And Dennis, we will wait and see and bring you back on to talk about it, because you are one of my faves. It's always a pleasure talking to you. That was Dennis
Thanks,
Gartman,
Erin.
publisher of the Gartman Letter. Time now for a very quick